Welcome to the debate. Today, we are diving straight into what is shaping up to be, well, probably the most significant and definitely the most volatile financial event of the decade. We are analyzing the rumored initial public offering of OpenAI, which is currently projected for late 2026. And the numbers circulating in the private markets right now are just astronomical. We are talking about a valuation that is attempting to break the psychological and financial sound barrier of $1 trillion.
Right. 1 trillion. It is a number that absolutely demands attention. But the question we have to answer today, and I think we have to be extremely rigorous about this, is whether that number represents a rational pricing of a true technological rupture, or, if it is just a collective financial hallucination that is actively ignoring 75 years of economic history.
Yeah, exactly. So to set the stage for our listeners, let's just ground this in the present moment. It is February 2026. OpenAI is currently finalizing a fundraising round at a valuation hovering right around $850 billion. And the target for the IPO later this year is that hallucinatory $1 trillion mark. I am here to argue that this valuation, while dizzying to traditionalists, is actually the correct pricing for a technology that is spreading faster than the internet itself. This isn't a bubble, it is a repricing of the global economy.
And I am here to tell you that this valuation relies on a statistical impossibility. To justify this price, OpenAI effectively needs to do the corporate equivalent of a runner finishing a 100-meter sprint in under 5 seconds. I will be arguing that while the technology is undoubtedly real, I use it every day, the financial physics required to support this specific valuation simply do not exist. You are asking for a miracle, not a business plan.
Well, let's get straight into the mechanics of that claim, because I know your skepticism is rooted deeply in the growth rate required to make the math work. But look at the specific trajectory here. The market is pricing in a scenario where OpenAI multiplies its revenue by roughly 40 times in 5 years. We are moving from approximately $3.7 billion in 2024 to a projected $145 billion in 2029.
That is the math, yes. And that is exactly the problem.
It is aggressive, certainly. I won't deny that at all. But we are witnessing the exponential narrative in real time. The adoption of ChatGPT and its underlying models is occurring at a velocity we have literally never seen before. It is significantly faster than the internet adoption of the 1990s or even the mobile internet adoption of the 2000s. When you have a tool that integrates into every layer of the economy simultaneously, from coding to legal drafting to creative design, the revenue curve doesn't look linear, it looks vertical.
Sure.
The massive investments we are seeing, the hundreds of billions in capital expenditure, they aren't just costs, they are industrial agreements. They are the world's largest companies acknowledging that they must pay OpenAI to survive.
The story is seductive. It always is during a boom. It feels like the future is arriving all at once. But let me bring us back to gravity with what I call the runner analogy. You are betting on OpenAI to break records. But to win this specific financial wager, OpenAI doesn't just need to be the fastest company in history. They need to run twice as fast as the fastest human ever recorded. If Usain Bolt runs the 100-meter dash in 9.58 seconds, the market is currently pricing OpenAI to run it in under 5 seconds.
Okay, so you are referring to the base rate probability of that kind of growth.
Precisely. I am looking at a specific study by Morgan Stanley that analyzed 75 years of corporate data. They looked at 19,000 observations of companies that started exactly where OpenAI is today, with between $2 billion and $5 billion in revenue. They tracked them for 5 years. The average growth for these companies is 7% per year.
But surely we can agree OpenAI is not an average company. It is an outlier by definition.
Agreed, they are exceptional, but the deviation here is absurd. OpenAI requires 108% annual growth for 5 consecutive years to justify this valuation. In that entire data set of 19,000 observations, do you know how many companies achieved that? 0. Not Amazon during the absolute peak of the e-commerce boom. They managed about 29% per year. Not Google from 2004 to 2009, which is arguably the greatest money printing machine ever invented. They did 49% per year.
Betting on OpenAI at 1 trillion is betting on an event that is 9.5 standard deviations above the mean. Mathematically, the probability is roughly 1 in 500 billion. You are betting on a black swan event that has never happened in the history of modern capitalism.
I understand the statistical weight of that argument, and I respect the data. But this is the classic looking in the rearview mirror problem. You are using historical statistics to measure a technology that breaks historical precedents.
The this time is different argument.
Yes, which is usually dangerous, I grant you. But sometimes things actually are different. You mentioned Google and Amazon. Their growth was constrained by the speed of physical infrastructure adoption. People needed to buy computers, get dial-up, then wait for broadband rollout. There was friction.
And you think AI is frictionless?
Essentially, yes. The infrastructure is already there. Billions of people have smartphones in their pockets right now. The distribution channel is instantaneous. Because the technology spreads faster than previous ones, the growth timeline is completely compressed. We could see a higher spike in revenue than historical averages simply because the friction of adoption is near zero. If I release a new AI model today, 1 billion people can use it tomorrow. Amazon had to build warehouses and delivery trucks. OpenAI just pushes code to a server. That allows for a velocity of revenue scaling that the Morgan Stanley beta simply cannot capture because it has never existed before.
Okay, that is a compelling point regarding distribution. I will give you that. The pipe is already laid. But have you considered the flip side of velocity? If adoption is faster, it often implies the growth cycle is shorter. It is a flash fire rather than a slow burn. You might get a massive spike, sure, but can you sustain 108% growth for 5 years straight? That is the mathematical trap. Even if the revolution is real, and I genuinely believe AI is a revolution, the financial projection can still be unreal. We saw this in the late 90s. The internet was revolutionary. It did change the world. But if you bought the valuations in 1999, which priced in infinite exponential growth, you lost everything. A real technological rupture does not guarantee a suspension of financial laws.
But the difference here is the immediate utility. In the late 90s, we were valuing companies based on eyeballs and potential clicks. Monetization was just a theory. It was get big fast and figure out the money later. OpenAI is generating billions in real revenue right now because the utility is tangible. Companies are integrating this into their workflows today. This isn't speculative, maybe one-day revenue. It's enterprise contracts being signed now because it saves money immediately. That creates a floor for the valuation that the dot-com companies never had.
It creates a floor, sure, but not a trillion-dollar floor. And let's look at the cost of generating that revenue. This brings us to the economics of software versus physical infrastructure, or the CAPEX problem. We tend to think of OpenAI as a software company, like Google or Facebook. Google's core business was an algorithm. It required relatively low capital investment to scale initially. It was brainpower and code. Generative AI is entirely different. It is heavy industry disguised as software.
You are referring to the compute requirements, the GPUs.
Exactly. It requires massive physical infrastructure, data centers, factories, energy grids, cooling systems. This triggers what analysts call the mega project law. Morgan Stanley's data shows that less than 10% of large-scale infrastructure projects respect their deadlines and budgets. When you are building physical things, you run into physical problems. Supply chain bottlenecks, energy shortages, regulatory delays. You can't just code your way out of a power shortage.
I see why you view that as a liability, particularly if you look at it through the lens of a traditional software margin. But I would frame it very differently. The $100 billion OpenAI aims to raise in the IPO, that war chest, is a feature, not a bug. It is a barrier to entry. They are building the factories of the 21st century. These are strategic assets. By spending this money, they are securing the capacity that no startup can match. It is an industrial moat. If you want to compete, you need $100 billion. That narrows the field to almost zero. It solidifies their monopoly.
But it is a moat made of assets that rot. This is the critical distinction between building a bridge and building a data center. If I build a bridge, it lasts 50 years, it generates value for decades with minimal maintenance. If I build a data center full of H100 or Blackwell chips, how long does that asset last? 2 years? Maybe 3?
Well, the innovation cycle is fast, yes.
It is incredibly fast. The chips become obsolete the moment the next generation launches. This turns what you call an investment into what I call a permanent expense. They have to replace the entire infrastructure every few years just to stay current. It is incredibly difficult to generate a return on invested capital superior to the cost of capital when your capital base evaporates every 24 months. They are digging a hole that gets deeper the faster they try to climb out of it. To make a trillion-dollar valuation work, you need high margins and low capital intensity. OpenAI has the exact opposite: heavy capital intensity and potentially compressing margins.
I think you are underestimating the signaling value of this spending and who is actually doing the spending alongside them. Look at the partners here: Microsoft, SoftBank, Amazon. They are pouring tens of billions into this. They aren't doing this blindly. They are signaling strength. It is a way to intimidate competitors. It is effectively saying, we have the capital to burn and you don't. It is a cost of doing business to stay relevant. Even Apple is being cautious, which suggests the big spend strategy is working to define the leaders. The market is consolidating around the players who can afford the table stakes.
Or it suggests Apple is the smart one staying out of the trap. Let me tell you a story about the fiber optic boom between 1997 and 2001. It is the perfect parable for this situation. Back then, the narrative was identical. Internet traffic is doubling every 100 days, a stat that was actually false, by the way, but everyone believed it. The narrative was that we need infinite bandwidth. Companies raised billions to lay millions of kilometers of fiber optic cable. They built the railroads of the internet.
Right. And the internet traffic did come. We use that fiber today. The prediction was correct in the long run.
The traffic came, yes, but the capacity came faster. They built so much so quickly that the price of bandwidth collapsed. The infrastructure builders, companies like Global Crossing, went completely bankrupt. They destroyed their capital. And who won? The users of that cheap infrastructure. The winners were Google, Facebook, Netflix, companies that didn't pay a dime to lay the cable, but built massive businesses on top of it. My fear for OpenAI is that by investing heavily in the infrastructure layer, they risk being the builder that creates value for everyone else while destroying their own balance sheet through overcapacity and commoditization. They are building the tracks so others can run the trains.
That is a fair historical parallel, I will admit. But there is a massive nuance you are missing. OpenAI isn't just the builder, they are the user. They aren't just laying the fiber, they own the Netflix running on it. ChatGPT is the killer app. They have the brand. When people think of AI, they think of ChatGPT. That brand value acts as a buffer against commoditization. It allows them to maintain margins even if the underlying compute becomes cheaper or more competitive. They have captured the mind share.
Is that moat really that deep? I'm sorry, but I just don't buy that the brand protects them from the race to the bottom. Look at the landscape right now. You have Anthropic with Claude, Google with Gemini, and a legion of open-source models like Llama. The technological barrier is falling rapidly. We are seeing that models are becoming surprisingly similar in performance. If I can get 99% of the performance of ChatGPT for half the price, or for free via an open-source model, why would I pay OpenAI's premium?
Similar but not equal. And for enterprise, that 1% difference is everything.
But is it enough to justify $1 trillion? If the models converge, what happens? A price war. And in a price war, margins melt. If you are valued at $1 trillion, you need luxury margins, software margins of 80 or 90%. You cannot support $1 trillion valuation with commodity margins. If intelligence becomes a utility, like electricity, the price trends toward the cost of production, and the cost of production is dropping.
But wait, OpenAI has the user data. They have the reinforcement learning loop from hundreds of millions of users. That is a flywheel that open source models cannot easily replicate. That data advantage preserves the quality gap, which preserves the pricing power. The more people use ChatGPT, the smarter it gets, and the harder it is for a competitor to catch up. It is a network effect on intelligence itself.
Perhaps for a time. But let's talk about the poison inside the financial structure itself. Dilution. This is something retail investors almost always overlook. OpenAI creates this amazing technology, but they are burning massive amounts of cash to do it. To preserve cash, they pay the best engineers on the planet in stock options. Huge amounts of stock. Plus, they have to keep raising capital to fund these data centers, that $100 billion we mentioned.
That is standard for high-growth tech. You have to pay for talent. You can't build the future with average engineers.
It is standard, but the scale is absolutely toxic for the retail investor. Think of the company as a pizza. Even if the pizza gets bigger, if they keep slicing it into smaller and smaller pieces to pay engineers and Microsoft, your slice, the investor's slice, doesn't grow. It is entirely possible for OpenAI to become a dominant company while its stock is a terrible investment, because the value per share is watered down to nothing. You are getting diluted by the talent war and the CapEx war simultaneously.
See, I think you are focusing too much on the mechanics of the old world. The argument for the trillion-dollar valuation is that AI is the last invention humanity will ever need to make. If OpenAI gets to AGI, artificial general intelligence, the economic value created isn't measured in billions. It is measured in huge percentages of global GDP. In that scenario, dilution doesn't matter because the pie becomes infinitely large. The market is pricing in the probability of that breakthrough. We aren't pricing a software company, we are pricing a new species of economic actor.
And that is the exact definition of a lottery ticket, not an investment. You are asking investors to pay a premium today for a godlike outcome tomorrow. But let's look at the mundane reality of the next 3 years. Once they go public, they have to show their books. The narrative fades, and the analysts start asking about gross margins, operating margins, and free cash flow. When they see that for every dollar of revenue, OpenAI is spending $1.50 on compute and stock compensation, the stock will be punished. The market eventually demands profitability over narrative. Gravity eventually applies to everyone, even the gods.
But the market also rewards dominance. And right now, the narrative is the dominance. The 75 years of economic history you cite are 75 years of humans building tools. We are now building a tool that builds tools. I maintain that we are witnessing a technological transformation where the standard rules of economic gravity, like mean reversion, may just be temporarily suspended by the sheer utility of this technology. We are pricing in a new era, not just a new company. If they succeed, $1 trillion will look cheap.
Temporarily suspended is a very dangerous phrase. Gravity always wins. While AI will transform the economy, I do agree with you there. The probability of one single company defying 75 years of economic statistics, requiring 0 companies out of 19,000 have ever done what they need to do, is virtually 0. The valuation assumes perfection in a messy physical world. It assumes no regulatory crackdowns, no energy crises, no better competitors. It is a remarkably fragile bet.
So we arrive at the core of our disagreement. We both agree that technology is real. We both agree it fundamentally changes the world. The wager is on the implementation and the capture of value.
Exactly. The wager is on whether a company can achieve a physically impossible financial sprint. It is a bet that OpenAI is not just a company, but a miracle. And history tells us that betting on miracles is a fantastic way to lose money.
And I suppose my position is that if any company can deliver a miracle, it is this one. The scale of the opportunity matches the scale of the risk. But as we wrap up, it is worth noting that we aren't declaring a winner today. The market will do that for us soon enough.
Indeed. And I will leave the listeners with this final thought. The danger isn't in believing in the technology. The danger is confusing what is technologically possible with what is financially probable. The story is beautiful, truly, but the numbers are stubborn.
We will see if the numbers bend to the will of intelligence. Thank you for listening to The Debate.
Thank you.